Hey everyone, welcome back to Corporate Decoder, the place where we dive into the nitty-gritty of corporate filings. Today, imagine you're trying to refinance your mortgage, but every time you get close, the bank adds a zero to the interest rate. That's kind of what we're seeing with Rocket Company's latest moves. More money, but at what cost? This filing is all about Rocket Companies, the parent company of Rocket Mortgage, making some big changes to their borrowing agreements. They're extending deadlines and increasing the amount of money they can borrow, but those details will have an impact. Before we dive in, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below if you want to chat about the latest. First up, this is a Form 8K, which companies file to announce major events that could affect their stock price. It's like a corporate news flash. This one is from June 11, 2025. The company we're talking about today is Rocket Companies Inc., based in Detroit. Now let's get into the meat of the filing. There seems to be a lot of financial movements. This section talks about a master repurchase agreement. Think of this agreement as a credit card for big companies. It lets them borrow money using their assets as collateral like a pawn shop, but on a much larger scale. Rocket Companies has extended and increased their existing agreement with JP Chase Bank. The termination date, or the day the agreement ends, has been pushed out from May of 2026 to June of 2026. To June of 2027, they also increased the amount they can borrow from $2 billion to limit on your credit card. They made some technical changes to the agreement. These kinds of changes could be anything from interest rates, fees, or the type of assets they can use as collateral. The report doesn't lay it out, which is a bit of a letdown, and instead they say it will be in the next report, which it should be in this report. Following this agreement, the company's total funding capacity, which is the total amount of money they can borrow from different sources, is now $28.2 billion. This figure was $5 billion at the end of 2024, so it's creeping upwards at a rate of a few hundred million a quarter. The message they are sending here is everything is going up 24, so it's creeping upwards at a rate of a few hundred million a quarter. The message they are sending here is everything is going up pools at a rate of a few hundred million a quarter. The message they are sending here is everything is going up. Besides JP Chase Bank also locked an extended line with Banco Santander, another financial institution. They've extended the expiration date of this agreement from June of 2026 to June of 2026 to June of 2027, matching the JP Chase agreement. The amount they can borrow has increased from $750 million to $1 billion. Again, it's a story of growth. Not everything went up. The company terminated another repurchase agreement with JP Chase Bank. No penalties or extra costs were incurred for ending this agreement early. This might be them consolidating their debts. The details we already talked about the borrowing agreements, are included here as a direct financial obligation. It's a fancy term for debt. Finally, the company held its annual meeting in June. Stockholders voted on a few key items. First, they elected 2 directors to the board, and they overwhelmingly approved the directors both had over 60 million votes for. Second, they approved the appointment of Ernst & Young as their accounting firm. Again, a big win with over 680 million votes foretold. Now for my assessment. Rocket Companies is increasing its borrowing capacity, but is that a good thing? Here's what I spotted. First, the good things. Rocket Companies appear to be stable. They are able to find multiple lenders. Now, some concerns. The company's debt is getting bigger, although not by much. They have to pay interest on all of this money, which cuts into their profits. Plus, if the housing market slows down, they might have trouble paying back all that debt. So for the company, it's stable. It's not that bad, but I would keep a close eye on this. What's your thoughts on what I have said? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.